Conventionally, I have always felt that wealth managers have started by saying, okay, let's look at an asset allocation, so to speak. I don't think that's what you're talking about here. You're talking about this whole concept of balance sheet, but does that actually mean every single penny that a person owns, and especially when a high net worth audience, because one would think that your assets have already sort of been allocated, so to speak. The usual scenario is money that's locked up in real estate, if I'm not mistaken, and then of course, you know, a mix of equities and everything else. What is the most intelligent way of looking at a balance sheet, and how do you guys do it, and how do you recommend it? I mean, I'm not just treating you as somebody who's got, you know, who's associated with Anand Rathi. I'm talking to you about as an investor who's very nimble on his feet.
First thing is to write down everything you have. Sometimes, now for example, I met a customer, he says, I've got 4 crores. Then I said, add your extra house, that came to 3 crores. Then I said, add your PF, he said 82 lakhs. Then I said, add all the insurance policies which you have been pushed down the throat. Then he came up with 57 lakhs. So when you actually drop, then he was surprised, oh, I actually have 11 crore balance sheet. Right? So first is to put the point A. What is your point A? Then you define your point B. Otherwise what happens is, some portion of your portfolio or your balance sheet is languishing. If it is languishing, if real estate, 5 years back, for example, I've been vocal about being negative on real estate from 2013, right? But if 50% of your money is going to earn you nothing for 5 years, then however well the other 50% does, you will never grow your entire balance sheet at 15% because half your money is earning 0, the other half needs to earn 30 to bring the average to 15. So point 1 is put down everything you have. Now, for example, when it comes to my money, I would have a net asset value sheet where every rupee is there, and that gets updated on a monthly basis.
Every rupee?
Every rupee.
Okay. Which
I am not using. By which I mean the house I live in is not a balance sheet. Okay, if I have a holiday home, which I do, that is got nothing to do with growth.
Right.
Even if that halves, I would want to live there. Right? So anything which I am not going to consume is a part of the balance sheet.
Okay.
And when it comes to balance sheet, if you have a balance sheet, then my wife knows that this is the balance sheet. She doesn't have to run pillar to post to understand what is there if I'm not there.
Okay.
Right? So that's very, very critical. If you did that, then you will be able to do true asset allocation, in my opinion.
Okay. So, interesting point you've made about inflation also. Which is that, you know, who inflation is really relevant for versus how that changes when it comes to a high net worth investor, so to speak. I think you've also given us a good idea of the kind of returns one should have. I think the figure you mentioned was 15%, which sounds, which for some people might think that does not sound that exciting, but that's really the realistic number we're looking at. This 15%, where does it come from in terms of what your understanding is?
Correct. When it comes to inflation, so government publishes this 3. So if I believe 12 is the hurdle rate, I have to make more than 12, and I don't want to take undue risk to beat 12. Correct?
Yeah.
So 15 to some people might look low. To some people say, nahi yaar, main apne business mein 25 kamata hu. Right? I earn 25 in my business, so 15 doesn't attract. But please understand, 15 on your overall balance sheet, where there will be something which earns 8 because there is deposits, there is something which earns 20. Most of us, when you look at a balance sheet concept, we wouldn't have made 15. Okay, I have analyzed several people's balance sheet because we are looking at the best instrument and then seeing whether 15 has been made, point 1. Point 2, if 20 was very easy, why is Warren Buffett so popular with 23? Right? What makes Mr. Warren Buffett what he is? He earned only 23. So 15 consistently is what I'm saying.
Okay.
In the aspiration to make 20, I don't want my client to end at -5.
And that's something that you've seen happen repeatedly.
That always happens. Bigger numbers come with lower probability. See, if I have to lose 2 kgs weight, the chances I will lose it 90% probability that I'll lose it.
Yeah.
If I say I want to lose 20 kgs weight, it may happen, but the chance is very low. So always bigger numbers in life come with lower chance. An investor should always look at high chance of making 15% consistently, then a higher return.
On the overall balance sheet?
On the overall balance sheet.
Okay.
That's the correction.
Okay. Now, if one was to get into, and I say this, you know, in a year that we're looking at elections. I mean, look, I'm from a news channel, so I will bring up something that's very contemporary. When the assembly elections, the state election results came out, one of the prime concerns we had on our callers, all the viewers had, was about realigning their portfolio because of the volatility that they were anticipating. Of course, the markets also bring in, you know, they take in a lot of that information, so to speak. But number one, how would you describe volatility in the markets going forward right now? And how should an HNI especially look at opportunity in volatility?
Right. So, volatility, matlab, something which is unexpected, upar niche, okay, which is also called risk. Okay, risk and volatility is one and the same. Now, the problem with most of us, or something which we have missed so far, is that when it comes to risk, we are okay with an English definition.
Yeah.
Return, they want in numbers. Risk is always in English. Zada risk, kam risk, moderate, high, low. Risk is measurable. So risk is measured in 5 different methods. Let's forget 5 methods. Let's stick to Fatima's point of how do you measure risk. We have to measure risk. To manage anything, the first step is to measure. So far, people are okay to not measure risk. They are only using English words, low, medium, high. Risk is measured in a word called standard deviation. Sounds more complex, it is very simple. Standard deviation tells you, अगर मैं 15 की उम्मीद करता हूं, तो कितनी deviation होने की संभावना है? Right? What is the chance of deviating from 15? Lower the deviation, the more comforted I am. Correct? So, standard deviation of Nifty is 13. So, point 1 I am making is, ask yourself, do you want risk to be English word or mathematics word? If we are okay with English word, then we continue the same way for the next 10, 15, 20 years. If you want mathematics to it, we have to spend 5 minutes to understand what is the mathematical way. And standard deviation, which is also called volatility, is a good mathematical way. So if there is a mathematical way, what is Nifty standard deviation? 13, 1, 3. Nifty standard deviation is 13. How it is calculated, how does it come? That's all secondary. If your portfolio standard deviation comes as 20, that means you're taking more risk than Nifty. If it comes as 5, celebration, right? If it comes as 20. Okay. So what should one do? They should calculate their own portfolio standard deviation and then check what it is.
Okay.
If it is 20, be scared. If it is 5, 7, it is time to party. If you have put all your money in deposit, deviation is 0. If you have put all your money in a fixed deposit, if you have been told 8%, you will get 8%. So there is no deviation. So standard deviation of a fixed deposit is 0. Standard deviation of Nifty is 13. Standard deviations of equity mutual funds is 14 to 15. Quite a few advisors give PMS's portfolio management service. They don't even check the standard deviation. It is 18 to 20. So I don't like PMS because I see the standard deviation and I get scared. Investors don't see that and they buy it.
Okay, so once again I want to come back to that basic question I was coming to, which is, and I find it very interesting how you're highlighting the idea of risk, and also how we seem to have a conventional way of looking at it when it's actually something that one is not to be scared of in a sense. It's a mathematical equation you're looking at. Given what you've said, given what you've talked about in terms of having the overall balance sheet, Feroze, how would one actually go about asset allocation in a portfolio, so to speak? Let's just make the assumption that, especially with HNI portfolios, what one has seen is that typically you have, the property, the ones that count, that do not count, as you said, as investments. What should asset allocation look like when liquidity is a concern? So is taxation, as you brought up, and so is planning. What is a good way of allocating assets?
Correct. So what is the current recommended asset allocation?
Yeah.
To my mind, next 10 years, India is going to go through a large economic growth, which is very, very evident. It's a writing on the wall. Irrespective of governments, I think the country is poised to grow in the economic parameters. Why? Because think of a country which is growing at 8% in spite of money, capital, interest rates being at 9%. Paisa बहुत महंगा है in India. I'm just for the benefit of trying to make it laymanish. Money is very expensive in India because the rates are 9%, 8%. In Japan, it is 0.5%. So you can borrow money and invest in your business. But in India, is capital very expensive? It is very expensive. In spite of expensive capital, if the country can grow at 8%, when capital becomes cheap, the propensity for this country to grow is enormous. We hear so much about what has this government done and all that. But if you look at reality, we were the 10th economy in the world. As we speak, we are the 5th or 6th economy in the last 4 years. So from the 10th position, we have come to 5th position. This is the first time we are beating Britishers in economic size. So it's a matter of pride to me, at least, when I look at this, saying that the people who ruled us for centuries, this is the first time our economic strength, at least in terms of the size of the economy, is greater than Britain. So our 2.2 odd trillion economy should in the next 10 years become 6 trillion. If it becomes 5-6 trillion, there is too much money to be made, and I think equity has a larger propensity to capture this growth.
Okay.
So coming back to your pointed question, I'm sorry, I'm giving a context before I give you the asset allocation. 60 to 65% should be equity. Real estate, in our opinion, has gone significantly ahead than it deserves to. Why? Because real estate and equity are the two assets which can help you beat inflation. Deposits and gold cannot beat inflation. By design, they will not beat inflation. If my aspiration is to beat inflation, then I have to rely on equity and real estate. Real estate, as the country is growing laterally upwards, 20 years real estate was flat. Flat in the sense people are not using the third dimension of the world. Now if you go Mumbai, I can speak of Mumbai very easily. Lower Parel, anybody who has 2 acres of land, he wants to build something which is 70 story.
Yeah.
Right? So land is limited, but you can go 50, 70 stories. So real estate is going to go through a correction. For the last 5 years it has. I think another 4-5 years of time correction can happen. So I would not bet on real estate to beat inflation. So equity 60-65%, 30-35% of debt. This is the ideal allocation.
Okay.
In my opinion. Gold, to my mind, should not have an allocation.
Yeah.
Because it's not even an asset.
It's a sentiment.
It's a currency.
Yeah.
Okay. Gold, we have to remember, started in this world as a currency. It is not an asset. An asset is something which derives value. When I buy a share of a company, there are lakhs of people going to work there. When I buy a gold bar, put it in the locker, after 100 years, if I open that bar, or my child or a grandchild open that bar, open that locker, how many bars will I find? I'll find the same 1 bar.
Yeah.
But if I take equity or take a share of Infosys and put it in the locker, which is called demat account, if I open it after 100 years, 1 Infosys share would have produced another 1,000 Infosys shares.
Correct.
Right? But
Because
gold does not reproduce.
Sure.
Equities reproduce. If I buy an FD, with the interest I can buy 1 more FD in the next 8 years. So that's why gold should be negligible.
Okay. I want to bring up this whole idea of mutual funds, of course, and clarity on that. There are many mutual fund schemes that exist in the market. How does one go about selecting the right one, and really how much should you be diversified when it comes to even that selection?
Correct. I think mutual funds selection should not happen on the basis of past performance.
Don't do it on the basis of past performance.
No. Okay, because you hear the disclaimer saying that mutual fund past performance is not an indication of the future.
Yeah.
So we try to use a relatively better method, not the best method, because nobody can predict the future to perfection. But just relying on past performance is a reasonable. We used to do that 6 years back. Then we said, yeah, this is not what we should do. We should use statistical tools available. We use something called regression, which is called statistical astrology.
Yeah.
Which has a better capability to predict the future, better capability. The other thing which you should do is, which we try and do, is to get the, like every share, when you buy a share, when I recommend a share to a person, he generally or she generally says, what is the target price? Right? If I told, I would not recommend them to buy a share. Let's assume I recommend somebody to buy a share.
Yeah.
The next obvious question is, आज ये 100 रुपए का है, कितने पे पहुंचेगा? That's the obvious question. They always ask for a target. Similarly, we try and compute what is the target NAV of a fund. Okay, because every stock has a target given by the best analyst. So coming back to the question you asked, point one I'm making is mutual fund selection. Because there are 400 odd equity funds, I have to choose 6 from them. If I have to choose 6 out of 400, that's a tough task. If I have to choose 6 out of 10, it's an easier task. How does, the second point I'm making is, you should not look at past performance. There are better methods available in mathematics to choose a fund. We try to use it and we improvise our selection as we progress.
Okay.
One is regression, I'm telling you.
Yeah.
One more thing which is very, very important to do is to see every stock inside the fund, what is the target for each stock, and find out the target of the entire basket. The higher the target from where that fund is, the more the interesting that investment opportunity becomes.
Okay.
Does the country calculate target NAV? Most people don't, and it didn't occur to us till 3 years back also.
So this is Anand Rathi actually prioritizing the way to do it, is it?
So yeah, that's what we do.
Yeah.
When did it occur to us? Something as simple as this occurred not 10 years back, but we learn, and then we've been using this in the recent past.
What is the whole story with structuring assets, and how much of assets can be structured, put into structured products? I know you yourself are someone who's, been at the forefront of it in terms of your understanding of it as well as experience. Tell me a little bit more about structuring assets as well as the relevance that has, especially for H&I clients.
So structured products, see what happens is when you have all your money, should you have some money which is a plan B? See, most portfolios, the reason why structured products are important to my mind is whenever an advisor creates a portfolio for a client, he always assumes that the advisor will go right and creates the portfolio.
Right.
Will the advisor always go right? No, I will go wrong. I will try not to go wrong, right? I will think the market will do well, but there could be something else in store. Right? So advisors generally have this tendency to create a portfolio assuming that you will go right. That's your plan A. But if he goes wrong, what is your plan B? When small things in life require a plan B, like if I go to a restaurant on a Sunday, I say if I don't get a reservation here, I will go there. Should investment portfolios be created as plan A and plan B? In our opinion, there should be a plan B.
Okay.
Right? If it has to be plan B, there are several plan Bs we debated. We came to a conclusion that structure products are a very good plan B for 2 reasons. One is there is no human being managing it every day. Like mutual fund, there is a person who is managing it. Structure product does not require any management. It is mechanical. It is beginning and end. There is no fund manager. There is only a trader who creates the product. Second reason why it is good is when the market defaults. Market gives you 4% a year.
Yeah.
Is that good return? No. If market gives 15%, 20%, great return. But if market gave 4%, structure product can give you 16, 17%. How do you design this product? So we explain to our clients how these products are designed. The flip side is, the problem is that you will never make more than 17.
You'll never make more than?
17.
17%.
You will lock in 17. If the market triples also, you are stuck at 17. Right? So that's the flip side of a structure product. So we recommend 30 to 40% of one's portfolio in structure products.
As plan B?
As plan B.
Okay.
Plan A is 60%. If the market does well, this 60 does very well.
Sure.
If it doesn't, then structure product comes to my rescue. So that the portfolios become low risk. That's
okay. So just to go back to PMS as well as alternative investment products. Number one, your key observation when it comes to HNIs and your experience, how that ratio has really been and how, whether it's changed in the recent past. And what are your views on the entire scenario there?
Correct.
You sort of mentioned it earlier, but I just want you to flesh out what you were saying there.
Super. Portfolio management service, abbreviated as PMS, is one product which today by wealth management industry is being sold the most. Okay, so we wanted to decipher, and Anand Rathi doesn't give its client PMSs. Because we think they're significantly higher on risk and their returns are not significantly higher. April 2015, mutual fund commissions were capped to 1%. Earlier mutual funds could give me 4% upfront commission. They were capped to 1%. As soon as mutual fund commissions were capped, we as an industry switched to PMS because PMS can give unlimited upfront commission. So PMS, average top 10 PMSs of the country give 5% upfront commission. 4-5%. That's the average. Right? Mutual funds now, after October, can't give upfront commission. The regulator on 22nd October of 2018 said that on the day one, no mutual fund distributor will get any commission on day one. If the client stays, I get commission. If client's money is double, then I double my commission. So both the advisor and the client are on the same side of the table now, which the regulator mandated. So PMS, one is its risk is more. Two, why did the industry go through such a large growth? It grew by 20 times in 2 years. In 20 years, it didn't go anywhere. In 18 years, 17 years, it didn't go anywhere. But in 2 years, it became 20 times. Then I wonder, yaar, what is this sudden rush to buy PMSs? It is the differential commission, and I think SEBI is working on bringing PMSs and other products also on par with commissions on mutual fund. That will be a very good thing so that people get unbiased advice. Third, if you want a concentrated portfolio, PMSs give you only 10 stocks, 15 stocks. That's the advantage of PMS. That's why risk is more, return could also be more. SEBI has started one more category under mutual fund, which is called focused equity. Focused equity funds, which were launched recently from 1st April, can replace PMS very, very easily. If you actually want a very concentrated portfolio, you don't want 50 stocks, and you actually want to take some risk on your portfolio for a portion, then also you should not take PMS, because on April 1st, 2018, SEBI has launched a separate category under the mutual fund basket called focused equity.
Okay.
Right, and you have a 13 stock portfolio managed by a mutual fund.
So that points me in another sort of line of questioning, which is that say somebody has already got certain products that they have in their portfolio, okay, and they haven't met Feroze yet. They're not sitting in this evening in Hyderabad. And they suddenly say that they really need to perhaps, I mean, first of all, the wise thing to do is to get the advice in terms of that overall balance sheet and see what they have. But if you actually want to go about removing, adding, fixing things, short term, long term, is that possible? And how important is it to rebalance? And what is the kind of timeline one should keep when it comes to reviewing your portfolio?
Yes, it is very easy for me to say 65 and although 35 and although.
Yeah, what's a realistic way of doing
But
things?
actually the end of the actual meat is that the money is not in the bank account.
Yeah.
It is placed somewhere else. When you make any transition, there is cost to transition, there is taxation, there is exit loads. So it requires a lot of deliberation before you move the money.
Before the surgery.
Before the surgery. It is very important. So we generally say, even if I have to make a change, even if my strategy is to go 65-35, it might take me 1 year, 2 years to implement the strategy. That is why when we define the 4 steps, objective, strategy, implementation of strategy is a distinctly different step Because strategy to implementation might take 2 years. Because because I believe that it should be 65-35, I can't let my client go through tax implications and cost implications and then move him somewhere. No? Now for example, now if people are sitting on real estate, okay, which we are, as Indians, 60% of HNI money is in real estate. That's the study.
That's the truth.
Right?
Yeah.
But people don't know one thing, which I think I should tell in this context of asset allocation, that in April, when February budget of 2016 came in, Arun Jaitley gave us a discount on taxation of real estate. We didn't even maybe realize it. So let me highlight it to those people who don't know already. If you have an ancestral property, most likely, any property you have bought in the 90s, most likely is tax-free to exit now. Can you believe it? One of my clients who had bought one villa or a bungalow in Breach Candy from 1 lakh to 30 crores in 1967 till now.
Yeah.
The tax was 6.5 crores.
Sure.
Now the tax is minus 2 crores. That means you get a tax discount. The tax has become 0, and he also gets a tax discount of 2 crores, which he can use in the next 8 years. What did he say? He said that the index year has changed from the 1980s to 2000. Okay, so the index year has changed. You have to use a government valuer and take the benefit of this. So the reason why I'm saying this is, if I'm stuck with real estate today and I have bought it at very low prices in the past, you will get a tax, almost negligible tax. So all your properties, somebody has to calculate what is the new taxation. Then you will be able to derive a strategy to sell it. So he said, okay, I'm not getting 30 crores, I'm getting 28 crores. I will sell it at 28 because now I've got a tax discount of 6 crores.
Correct.
So it was easy for him to sell that, because otherwise he was saying he always was adamant that he wanted his 30 crores. But once I told him that you're saving 6 crores of tax, give away 2 crores of discount.
The whole maths looks different.
Now
then.
he was able to sell it.
Sure.
That's when the transition will happen.
And that's again going back to the balance sheet concept in a sense, right?
Balance sheet, if somebody gives you an advice,
that
means he's only wanting to take that money which is there in your bank account, to my mind.
Also, the other thing is, I think it's quite dangerous because sometimes, and I'm talking about personal experience, there's a bit of confusion, I feel, especially when the word tax comes up, in terms of the role of an advisory firm versus a financial advisor versus a chartered accountant. So tell me a little bit more about how important you think it is for your HNI especially to really understand the role of the CA versus the role of a financial advisory, the role of somebody who's an independent, manager. Tell me, I'm asking you about your experience here.
So CAs are very, very good at taxation.
Yeah.
Okay, but they are maybe not worried of investment taxation so much.
Correct.
Unless the client asks this question, have you used new indexation? And I'll give you, firstly, CAs are a very, very smart group. That's why they're CAs. They're a very intelligent group. Their attention is not on investment taxation.
Okay.
Unless my client asks the CA that, have you used the indexation, new indexation year, he might not be reminded to do it. And I'll tell you, a very big client who sold his house to Bini Bansal. Okay, he uses that guy's CA, but he had forgotten to take the government valuer and move the investment index year from 1980s to 2000.
Okay.
So point is, they're very capable, but they need to be reminded. Unless you are reminded, that will go by the wayside. So the job of the advisor is to make sure that he also highlights to the CA saying that you please consider this, so that the taxation is optimal, not lesser. And I think that's paramount, because the only thing, everywhere, if you're advisor, if I earn you even a rupee somewhere, I have taken some risk. Tax is the only free lunch, and I can't have my clients missing the only free lunch available in the investment world.
Okay.
So that's important.
I'd love to open up the floor to a few questions if you have them.
My name is Kumkum Shrivastava, and I have been a client of Anand Rathi, pretty recent. I joined as a client, which is in January of 2018. Feroze, I've gone through all the motions in terms of attending an FGD of doing the 3-hour one-on-one strategy plan, etc. And I have been given a commitment of 13 to 15% on my total portfolio, which again I share the same sentiment as the gentleman there, that if we are targeting 13, then will we really beat the inflation. But more than that, maybe my question is a little premature, because this commitment of 13 to 15% has been made over a 3-year horizon, right? We are sitting at about 12 months ever since I've been associated with Anand Rathi. Today my portfolio is sitting at a minus, all right? And I am hugely concerned. And I have these almost every month, chats with my relationship manager. And one of the very, very direct questions was, I'm willing to wait, but after 3 years, if it doesn't happen, what will you do? The response I got was, you can withdraw your capital from Anand Rathi. Now, is that acceptable to you? And B, what would you do if you were in my position today, where my portfolio is sitting at a minus?
Wonderful.
Good question.
And let me just add, I'm kind of reassured, because my portfolio today is the asset allocation has been done on a 65-35. I have a structured product in my portfolio, but despite that, I am highly concerned because I'm a retired individual.
Right.
Yeah.
Great question.
So, very, very important question. So, firstly, if you're in the negative zone, how much negative is the most important point? 2%. You're 2% negative. Wonderful. So, this year, you've gone exactly as per our strategy. One thing which clearly comes out is, we don't let people operate without the system. See, if I say 65-35, and if my advisors have done 80-20, it seldom happens. So we made sure that all the mathematics percolates to all the 9 regions which we operate and all the thousands of families, so that we are mathematically driven rather than perception of that individual driven. So that's reassuring to me. One happy thing in the conversation, but the sad thing is the response is definitely something which disappoints me, saying that you withdraw your capital. So that still doesn't bring you back those 3 years of return. So I'm disappointed. I'll have this conversation with the person and try and make sure that the you will have to see. So if that question was posed to me, how would I answer? Okay, and that could again be a dissatisfactory answer, but at least I would want to attempt to answer it in a different fashion. See, if I'm minus 2%, okay, so minus is minus. See, what happens is, we as emotional people, human beings, all of us are emotional. It hurts me lesser to lose return, but see, if you have made 10 or 8, that 2% will not hurt you so much, but the capital 2% will hurt me more, right? To me, at least. I don't know as an individual to you, because if you're retired, then it's important. So point 1 is, if half the Bombay Stock Exchange stocks are 35% down, that is reality. Out of the 4,000 stocks, 2,000 stocks are 30 to 35% down. Now in that situation, if I'm 2% down, the good part of that is, when the tide turns, because if I don't fall, but if I rise, then the fall is beneficial to me. Okay, so point 1 I'm making is, in what context did I lose this 2%? If I have lost that context when the market fell 4%, then I would be very disappointed with the 2%. If the market overall fell 20%, then I lost 2%, the same 2%, I would be looking at that 2% little more positively than the other 2% that market do gayi, main bhi niche 2 chala gaya. So these 2% optically are identical, but I would be more happy when I lost 2% when the markets fell 20%. Now if you have taken structure products, you will also realize that that structure product would come with a 15% protection at maturity. Okay, so most of the products we do on the structure product category would have a maturity protection. So in my opinion, point one I'm making is relative return is okay, because relatively you're okay, because the market's large portion of the market is 30-35% down. Point two is that when you actually wait till maturity, your target return on structure products, which is your plan B, even after this level of Nifty, you will need not more than 12-13,000, not more than 5-6% growth in Nifty will be needed for you to get 16-17% on 35% of your money, 30% of your money. You can recheck that. So structure product plan B will become active, may not be displaying it today, but the time is conducive for it to be active. The difference between sir and you, madam, is that there is a time lapse. So structure product he would have had maybe for longer, and it would have come to maturity, and you would have seen that coming to the support of the portfolio. Point three is, whenever we do this strategy, we back test it for 25 years. If I would have done the same strategy for all the 7,000 days, every day if I would have met you and did it, what would have been your worst return? What would your best return be? And your worst return could still be 6%. So what we do is, when we do the strategy, as a homework we check, if I did the same thing for 25 years every day, the luckiest investor and the unluckiest investor, how far away they are. So we do that test, and then we make sure that all of us follow the same portfolio and manage risk in a different way. So point one is, one assurance is that this has been back tested for long periods of time. The second assurance is, when the market is in very bad shape, when you see PMSs having lost 20, 30, 40% of the portfolios, that's a very, very popular instrument in the marketplace. When you see that it's been just a year and minus 2%, I would say that you will get those 6-7% in a worse 3-year period, in my opinion.
My name is Venkateshwar Rao. You mentioned about structured products, Mr. Feroze.
Yes, sir.
And you also mentioned about 65-35, right? So is 65, you also mentioned in another comment that your 65% is in structured products, right? So is that 65% structured product equivalent to the equity allocation, or is it separate from equity allocation? How are you going to look at it, right? Personally, I was a beneficiary of Anand Rathi's equity structured product, so thank you. Again, fortunately, I have not been in the losing cycle, so I have been fortunate in that sense. But I would like to know, is that 65-35 more of equity allocation, or is it a separate allocation?
Yes, wonderful, sir. So first question, you're absolutely right. If I buy a share which doesn't remain contemporary for 100 years, I completely subscribe to the same opinion. People have moved from one technology platform to another, and Instagram is today is far bigger, and I think things will change as we progress. Only reason why I make a very large point when it comes to gold is, it hurts me to see that India has imported the maximum amount of gold in this world, and it's still not the richest country. Why? Because gold in dollar terms has given very, very abysmal returns. It has given 1% return for the last 35 years in dollar terms. But when we see it in rupee, it has become from 3,000 to 30,000. Because dollar has become stronger, rupee has become weaker. Even if I put my money, if I would have given my money to a NRI cousin of mine, if I brought it back, because rupee has become weaker and weaker, it was 10 rupees to a dollar, today it is 70 rupees to a dollar. So most of us forget that dollar is a global asset, and it is looking pretty in India only because rupee is losing its value. So it's a good hedge to currency. But most of us are importing so much gold. 20 years we have been the largest, so much so that the entire world's consumption, leaving the top 5, is equal to our consumption. And gold gave a negative return from 1979, the year I was born, till 2003 in dollar terms. Can you believe an asset giving negative return for 24 years?
We also know your age now.
Yeah,
and how wise you are for your years.
Yeah.
Yeah.
So I should have kept that a secret. But I was seeing $800 to an ounce. It took 34 years or whatever number of years,
Sure.
not 34, 24 years to come back. So
Right.
I generally say strongly about gold so that our affinity towards gold, which is very high, at least becomes mediocre rather than being on one extreme. So 60-65 on my balance sheet is in structures because I've been doing this for a living for the last 13 years. Is it allocation of all equity? No, there are two types of structure products. One is equity structure product, one is debt structure product. So I also have debt structure products and equity structure product. Incidental that the asset allocation was 65-35 and the product allocation also turned out to be 65-35. Hence that confusion. I'm so sorry I didn't communicate that well enough.
No, that's good.
So both of them incidentally are equal. So I have debt structures and equity structures both. And I'm glad that it has added value. But we have to also remind ourselves there will be phases where it will look like I made only 17, mutual fund made 25. There would be a phase where equities, mutual funds make 25, possibly, and structure will make you only 16. So that day we have to remind ourselves that it was not supposed to make more than 16, 17. Today it will, and I think it's quite likely that in the next 3 years it will do very well. Because as the Nifty base is very high, it doesn't make sense that Nifty can double and triple. If Nifty was 2000, like in 2003, it can become 6000.
Sure.
But it's difficult on a base of 11,000 Nifty to become 33,000 Nifty. It's the same return, but it is a very different thing. So the base is lost, so structures will have relevance for the next 5-7 years. And it will maybe beat or at least be equal to mutual fund. And
I think overall the planning scenario that you've looked at and how plan A will look if plan B is what happens, and that's very important.
Feroze, you said that you have, most of your equity investment is actually in the structured products. I have myself has invested in structured product for last 7 years through Anand Rathi, and I have had very good experience in terms of the returns and what it does to my overall portfolio. But looking at scenario these days, I am very worried about the credit risk that the structured products manufacturers or people like you who actually create these structured products have. So with this ILFS and all that stuff, when even liquid funds are not credit risk free, how structured products are perceived in your mind by being credit risk free, or should we adopt a strategy to mitigate that risk?
And can I just add to that question? I think it's great that you brought up the ILFS issue, because the concerns about liquidity and contagion that exist amongst investors is something that it'd be very interesting to see it from your point of view, how you would address that as a wealth manager as well as an investor.
Okay. I think it's a very important question. Let me fill in the people who have missed this news. There was one AAA rated company called ILFS. It was AAA rated, the highest credit rating, that this company will not go down. It will give back your money. That company on 3rd September, suddenly from AAA, the rating was downgraded by the rating agencies to default, 16 notches. AAA के बाद 16 स्टेप को डाउनग्रेड करके डिफॉल्ट हो गई. मतलब कंपनी एक दिन में AAA से बैंकरप्ट डिफॉल्ट की situation.
Yeah, and that's what also, by the way, I have to say this, that also has also started the whole process of looking at credit ratings themselves. The reason I bring that up is because you will have these kind of issues coming up in the future. So let's make it a larger question.
So why did this happen? Why did a company, which it was almost, it was a company which went default. Why did this happen? Because they were borrowing. That is called asset liability mismatch. लोगों से पैसे लिए 2 साल के, they borrowed for 2 years, lent it for 10 years. Okay, so that is called asset liability mismatch. 2 साल के पैसे लेके 2 साल के लिए उधार दो, 10 साल के लिए पैसे लेके 10 साल के लिए उधार दो. That is correctly matched. So ILFS went down. So why did this happen? Because the companies were borrowing. Some companies were borrowing for shorter period but lending for higher period. If you do this, you make more money. If you borrow for 1 year, lend it for 10 years, you make more money. So that's why they were doing it. That's not so important. What is important is to learn. And the learning which has already been derived, 6 years back we learned this, it just gets reinforced with this episode, that rating agencies cannot be a very foolproof mechanism to see whether the company is strong or not. It is not a good mechanism. That is exactly why Anand Rathi structure product has not taken a rating. It will help me sell twice more structure product. Today I collect 300-400 crores per month. If I have a rating, it is very easy for a person to, it is easy for us to move the sale or buying of structure products up. But we said we will not take a rating because rating agencies have gone wrong several times. Not just in ILFS case, before that in Amtech Auto it was AA, suddenly default. There is no reaction time for the investor. So the point I'm making is rating agencies have gone wrong several times. If rating agency is not a good method, but I'm lending my money to somebody, I still want to check here, because if he goes bankrupt, who gives me my money back? Of course there is a trustee, there is a collateral, but then I don't want to get into the situation. There is another method to make sure that your money is safe. Even if you buy 1 rupee of a bond,
Excuse me.
you should know of this method. I will introduce you to this method. This is called Altman Z-score. Okay, one of my favorite methods. In 1968, a professor Altman introduced this method, saying that use this to check whether the company is strong or not. And that has proved so much better than ratings. If I look at rating and invest, I would rather look at Altman Z-score or so-called Z-score. It is called as Z-score, simple. If I see the Z-score and invest, if I give you an example of Amtech Auto, sir, Amtech Auto, 4 years rating was same, but Altman Z-score said a completely different story. It clearly indicated 2 years before that you should get out immediately from that bond. Altman Z-score greater than 2.5. Altman Z-score, if it comes more than 2.5, very good.
Okay.
For a manufacturing company. So Amtech Auto first year gave 2.8. Great. Next year 1.3. Then 0.29. After the last 4th year, it gave minus 1.1 or 1.2. Altman Z-score completely deteriorated from 2.89 in 4 years to minus 1.1. Rating AA. Altman Z-score is a far better method to manage or understand credit rating.
Who does that for someone? How does one go about it?
I think it is the advisor's responsibility to first know.
So that's another insight.
Right? I have interviewed 400 relationship managers to hire 100.
Yeah.
Unfortunately, our industry is busy selling and marketing stuff rather than understanding finance concepts and using it to the benefit of the client.
Things are moving fast as well, I guess. Yeah.
Wonderful. So I think we as an industry need to become more finance oriented rather than sales oriented. Right? Is product mein kitna paisa collect karoge? This is what. If
I think that insight comes from you as an investor.
Correct. Yeah. So
That's
now investors are becoming more demanding. So point 1 to answer sir's question is to say, if credit rating is not a good method, check Altman Z-score. Will Anand Rathi be able to check Altman Z-score for any company and give you? Unfortunately, they are not available in public domain. It is very simple formula, 6 constituents of formula. I can calculate and tell you for any number of companies. At least for the top 100 companies, we calculate on a regular basis.
Okay.
And if there is some specific company, if you are running a company yourself, you should check your Altman Z-score yourself for your own company. If you are running a company, especially a manufacturing company. Now comes Anand Rathi's Altman Z-score is 4.5. So I check my Altman Z-score on a very regular basis. And if there is something which deteriorates, then I'll correct the course before I come to a situation of bankruptcy. Second is, we are one of the companies which has no asset liability mismatch. So if generally when all the lenders come on one day and say, give me back my money, that phenomena is called run for money. Run for money means I go to a bank and say, all of us go together and say, give us back our monies. A bank will go bankrupt, right? But Anand Rathi can never have run for money because all the investments because this NBFC is only for structured product,
Okay.
no other clutter. So all the 4,000 crores is from structured product. So it's a separate entity, which is not 4,000 crore from structured product, 20,000 crores from some other business in the NBFC is not there. So we have kept it a very simple NBFC, and this is NBFC only exists so that my clients can buy structured product.
Okay.
It is not a parallel business, and we have made sure that the lending is not more than 1 year. I have borrowed for 3 years. Your structured product would be 3.5 years. Sir's structured product would be 3.5 years, because we think it takes, your structured product would be 3.5 years. So I lend for less than 3.5 years. So if I borrowed for 3.5 years and lent for 10 years, then that asset liability. So we try and manage very, very closely. And that's why we don't clutter this business with other 20,000 crore other borrowing. So that's one way we control risk very, very strongly, because Mr. Rathi's market cap would be 5,000, 6,000 crores. Right, my division, which we are expected to get listed, is having an expected valuation of 3,000 crores. As a Marwadi gentleman, I'm telling you the inside. So he says, yeah, I don't want to spoil my name, because I've given my name to the company. So he's very clear that risks of the NBFC cannot be extra. So that's how we try and manage it. Of course, we learn in the course, and if there is some course correction, we do it sooner.
And you've mentioned that a few times, how the firm has changed its strategy through experience.
Yeah, we have to learn and write it down and correct.
Yeah.
So we check Altman Z-score every month. My balance sheet gets made every month, and my Altman Z-scores get changed every month. If there is a dip, then even if there's a marginal dip, I see what contributed to that marginal dip.
I think it's about time we wrapped up, actually. And Feroze, of course, is someone who, as we know, is very accessible and full of knowledge. And it's been wonderful, actually, for me to be able to see how the audience has asked some very involved questions. You know, these are people with the portfolios who are seeing their alignment with an Anand Rathi. So I think that's wonderful. I just want to thank you all for having been an amazing audience. And Feroze, of course, for having answered those questions very well and really taken us through what's been happening today. So thank you very much for this
Fatima,
evening.
you're a very modest lady. You have been tracking markets more than I have. The next time I have to be asking you the question, it is unfair, or it's wasted knowledge if I didn't ask you the questions. I think thank you so much, Fatima.
Thank you. Thank you to
thank
all.
You, friends.
And we'll just open it up now.
Longer.
Thank you.